All right, this is Bernie Maybank. I'm here to talk about state and federal taxation of economic development incentives. I'm a two-time director of the South Carolina Department of Revenue and now in private practice with Adams and Reese. I have three listservs. Email me if you want to be on any of them. One advantage of being on them is that we do seminars in South Carolina, which are qualified for both lawyer CLE, CPE, and realtor credits. Um, we are one listserv is on economic development incentives, and I cover mainly South Carolina, but I have a lot of national topics in there too. I have a state and local tax SALT listserv. I cover almost exclusively South Carolina on that, so that's not for everybody. And then I have a realtors listserv and cover a number of interesting topics. So we do a realtor seminar every year. Realtors are required to get continuing education in South Carolina, and we qualify for that. And we're one of the few seminars which discusses commercial and industrial tax incentives. Most of the realtor seminars just deal with residential property. We deal with commercial and industrial incentives. And I have a lengthy memo on the topic that we're discussing today. So to any of y'all with a keen interest, and some of this is going to alarm y'all. So if you have a keen interest in it, just email me and I'll send you my lengthy memo. So the bottom line is, prior to passage of the Tax Cuts and Jobs Act, economic development incentives were not taxable to corporations, but were taxable to partnerships and LLCs. So the Tax Cut and Jobs Act made economic development incentives subject to federal income taxes for corporations. The Congress made this and the SALT deduction provision to lessen the revenue impact of the bill. So they predicted this would raise about $7 billion annually. And so it and the SALT deduction cap were done to lessen the revenue impact of the Tax Cuts and Jobs Act. Because the bill was so huge, it had so many changes in the tax law, there was very little discussion of the taxation of economic development incentives. And the tax press, which constantly is posting articles, there was very little discussion of it. You know, there's just so much had gone on in the bill. Very lately, there has been discussion of it because, and it was back in a big way, because the broadband industry was very concerned that they would have to return as much as 21% of the broadband grants or BEADs from the $42 billion broadband equity access and deployment program. So the IRS had indicated those grants, $42 billion, were subject to federal income tax. And so federal legislation to make broadband grants subject to not subject to federal income tax and was introduced in 2022 and reintroduced in 2023. They passed the House, but the Senate has really not taken them up. And so presumably the broadband industry has been very active in trying to get that legislation passed. Our General Assembly declared that broadband grants were not subject to state taxation in 2024. So just a couple of months ago, our General Assembly said they weren't subject to state taxation. So as I'll get into, the Federal Tax Cuts and Jobs Act made receipt of state and federal economic development incentives subject to federal income taxation to corporations. Corporations were previously not subject to federal income tax of incentives. Arguably, LLCs were subject to taxation. And so they were also subject to taxation in states which adopt the federal income tax code, which many states do. South Carolina was one of the first states to decouple from the provision we're getting discussed below, meaning that South Carolina did not adopt it, and many of the southeastern states also decoupled after South Carolina did as well. So the receipt of economic development incentives is almost uniquely transparent to the IRS. Normally, when the IRS wants to discover where somebody has not been paying taxes on income, they have to work very hard to discover that. They have to send out subpoenas. They have to do desk audits. They have to look hard, and that's why Congress passed a horrible Corporate Transparency Act several years ago, which just went into effect. By contrast, this is literally probably the easiest way for the IRS to discover income. All they have to do is look at most states' Department of Commerce or county websites to see the disbursement of grants and other economic development incentives to entities. GASP 77 now requires state and local governments to disclose incentives, and this is also a public document. So if the IRS ever wanted to really start tracking our corporations and LLCs paying taxes on incentives, it is literally almost uniquely easy for them to find that information. So GASP 77 went into law in 2017. So state and local governments are now required to report the incentives that they grant. The counties are allowed to do it on either an aggregate or a pro project basis, but the vast majority of them will do it on an aggregate basis. So it will, their GASP 77 report, which is a public document and reported online, just typically has it on an aggregate basis and doesn't have the actual names of the taxpayers. By contrast, the Department of Commerce's website in many states, they have the actual name of the taxpayer in there. So stated another way, the IRS can easily identify the receipt of economic development incentives by taxpayers, almost uniquely easy for them. They really, when they're looking as to whether corporations are not paying taxes on income, they have to go through many steps to discover the income. Here it is very transparent to the IRS. South Carolina, like all the southeastern states and many states across the country, has a rich mix of economic development incentives, including income, sales, property, tax, and credits, such as withholding credits. They also include cash grants from the Department of Commerce, set-aside funds, and the occasional county grant. And the states and the county also directly pay for or contribute land or public infrastructure to an economic development project. South Carolina tax increment financing statutes may result in substantial funds benefiting private real estate developers. So the question that we're going to discuss now are the receipt of these incentives trigger federal income tax liability to the fortunate recipient, and in some states, but not South Carolina, does it trigger state income tax liability? So the IRS has discussed incentives several times over the years. In 2008, they discussed it at length. Ironically, they discussed it in the context of some people were using incentives as a tax shelter, and the IRS went to considerable length to say you could not do that. So to use the simplest example, if a corporation got a fee in lieu of property taxes, their assessment ratio went from 10.5% to 6%. Well, they were taking under the tax shelter, they were taking a deduction of 10.5% as if they had paid taxes on 10.5% assessment ratio, when they're really only paying taxes on a 6% assessment ratio. So the IRS issued several documents in 2008 trying to block what they saw as a tax shelter strategy on economic development incentives. And they did, prior to the current law, they did consider receipt of some incentives as subject to federal income taxes. There's not a whole lot of case law on this, so the IRS must not be that aggressive, or taxpayers might just be simply writing a check and not going to court. So there were a few cases on incentives prior to the new law, and the IRS considers receipts of some incentives by non-corporate entities, such as LLCs and partnerships, as taxable income. So in the end of 2017, US Congress adopted H.R. 1, commonly referred to as the Tax Cuts and Jobs Act, which has substantially changed the rules for corporations. Arguably, LLCs were always subject to taxation on the receipt of incentives, which we'll get into in a minute. But it greatly changed the rules for corporations. And as I've indicated, the reason Congress adopted this particular provision was to try to minimize the revenue impact of the Tax Cut and Jobs Act. So our Internal Revenue Code section 61, and I'm not getting down into the nitty-gritty of the tax law. It basically says gross income means all income from whatever source derived unless excluded. Obviously, getting a multi-million-dollar grant or free property is income under Internal Revenue Code 661A. So it starts off in Federal Income Tax Code. It started off as being taxable, but there were several cases. So there was a U.S. Supreme Court cases where the U.S. Supreme Court held that governmental grants to corporations for economic development purposes were not income. And one of the more famous cases, Edwards versus Cuba Railroad Company. Cuba Railroad got subsidy payments from Cuba to build a railroad. The IRS claimed that that was taxable, and the U.S. Supreme Court held that it was not taxable. So Congress finally stepped in. There were several U.S. Supreme Court cases and a number of lower court cases arguing whether or not incentives were taxable to corporations. And so the Congress stepped in and all the way back in 1954, and they adopted Internal Revenue Code Section 118, which deals with contributions to the capital of a corporation. And Section 118 very explicitly said corporations to capital made by persons other than shareholders, i.e. the Department of Commerce, which gives you a grant, it applies. So it says, for example, that the exemption applies to the value of land or other property contributed to a corporation by a government or by a civic group for the purpose of inducing the corporation to locate its business in a particular community. So Section 18, all the way back in 1954, covered grants and other economic development incentives to a corporation. Now, Section 18, as we'll get into in a minute, is a corporate income tax provision that doesn't apply, as we'll get into, to LLCs and partnerships. So in 1954, Congress basically stepped in and said economic development incentives are not taxable income to the corporation. They are contributions to the capital of a corporation and not taxable. So in summary, they were not considered taxable income, and if they were included in gross income, they were excluded for taxation under Section 118 as contributions to capital. So when Congress adopted Section 118 in 1954, all they thought about was corporations. So Section 118 only applies to corporations and not partnerships or LLCs. And in 1954, very few partnerships received economic development incentives. Everybody did business in a corporate form, and LLCs weren't even recognized by any state until Wyoming adopted it in 1977. So you ask, why did Congress limit it, the receipt of incentives or not taxation? Why did they subject that just to corporations? Because in 1954, there were no LLCs, and partnerships were not receiving economic development incentives in 1954. So on December 22nd, 2017, former President Trump signed into law the Tax Cuts and Jobs Act. And as it said, it made the House bill contained a provision making certain incentives taxable to a corporation, and the Senate version was silent, and the conference committee adopted the House language, which made receipt of incentives by corporations subject to federal income taxes. The effective date was December 22nd, 2017. However, there was a safe harbor for incentives done pursuant to a master development plan, which had been approved prior to December 22nd, 2017. Master development plan had to be approved by a governmental entity, not private sector corporations. So the Tax Cut and Jobs Act repealed the prior exclusion, which excluded the value of land or property contributed to corporation by a governmental unit for the purpose of inducing the corporation to locate or expand its business in a particular community. So the bill repealed that particular provision. So it applies to contributions made after the enactment of the Act, i.e. December 22nd, 2017. And that alone, the effective date, is going to raise a lot of issues. What if a grant was approved prior to December 22nd, 2017, but cash didn't start flowing until 2018 or 2019. Are the 2018 and 2019 disbursements taxable? And the IRS is not answered that particular question. And of course, it's quite common for a grant given in 2017 for cash not to actually flow in 2018, 2019, or 2020, and sometimes for years after that. So that effective date raises issues. So it does have a grandfather clause made pursuant for contributions made after December 22nd, 2017, which is made pursuant to Master Development Plan, which has been approved prior to that date by the governmental entity. So the legislation uses the term, quote, Master Development Plan, but it's not a defined, Master Development Plan is not a defined term, nor a term of art. There's no definition of it in Black's Law Dictionary, Wikipedia, and I checked out several dictionaries, and there's no dictionary definition of Master Development Plan. So the IRS, it indicated they were going to define what that meant, and they said that for several years they were going to define it, but they have not still, as of 2023-24, they have still not defined what a master development plan is. They hadn't given an official definition. So in South Carolina, a master development plan would presumably include a planned unit development, a PUD, a planned development agreement, or South Carolina land development agreement or TIF plans, all of which are approved by local governments. There's no, IRS has not decreed that, but that presumably those entities would be included under the definition of master development plan. The second, so we've been over the receipt of economic development incentives by corporations, and to the shock of many, those corporations are now subject to federal income tax upon receipt of grants or free property, or the local government doing public infrastructure purely on behalf of a private sector. So the next thing we're turning to is partnerships. So partnerships do not have, the section 118 does not apply to partnerships. So in 1972, a revenue ruling to a non-corporate entity were not includable in gross income. But they didn't explain why that was the case, since section 118 doesn't apply to partnerships. Similarly, in 1979, the IRS held that a governmental grant to a non-corporate taxpayer, a public utility partnership, qualified for the section 118 exclusion. And in 1980, the IRS held that governmental grants given to a limited partnership for the construction of hotel and residential units were excludable from gross income as they represented contribution to the capital of the partnership. So those were three very good rulings, very pro-taxpayer rulings regarding partnerships. Alas, they subsequently reversed course in a 1982 general memorandum, which dealt with governmental grants to partnerships in this particular case, for a housing partnership. So the IRS reversed course and held that section 118 only applied to a corporation. And in 1990, the IRS issued a technical advice memorandum, which said that the exclusion under 118 did not apply to partnerships. And then in 2011, the IRS issued in its appeals settlement guideline, which held at length that section 118 does not exclude grants from taxable income for non-corporate entities. So they had several pro-taxpayer rulings, and then they completely reversed course, making them subject to it. So they, in an industry directive regarding section 118 abuse, the IRS stated flatly that neither section 18 nor the common law contribution to the capital doctrine applies to partnerships. So they went into length in excluding partnerships and LLCs from the section 118 exclusion or the common law contribution to capital doctrine. That's all very bad law. So we do have, partnerships have arguably always been subject to taxation. Partnerships and LLCs for incentives. Corporations were previously not until 2017. So there are several non-codified doctrines or exclusions where you would, if the IRS came and said, why haven't you paid income tax on these wonderful incentives? So there are some uncodified exclusions for partnerships and LLCs and now corporations. The first is a general welfare exclusion, and entities are always claiming the general welfare exclusion, and those would be under the pandemic, all of the numerous incentives that were done on the pandemic to individuals. But the IRS has said the general welfare exclusion only applies to governmental grants to individuals outside of the business context, such as a disaster relief act or a flood relocation program, and don't apply to economic development incentives. So I include it, but it almost certainly doesn't apply. Lack of dominion and control is a big one, and it's something that everybody needs to be familiar with, because deals can be structured where the taxpayer does not have dominion and control. And the lengthy memorandum of law I discuss the lack of dominion and control doctrine at length, and it's something you definitely want to be familiar with, because grants can be structured to come under that exception, the lack of dominion and control exception. So the one big case was Likes Brothers Steamship versus a commissioner. A steamship used to carry mail, that proved unprofitable. So the government gave the steamship line a grant for the purpose of acquiring new ships and conditioning old ones. The taxpayer, when the IRS came knocking and said, why haven't you paid taxes on those grants? The taxpayer argued he had a lack of dominion and control, but the Fifth Circuit held the grant was not, the taxpayer did not lack dominion and control, because the grant was not required to be deposited into a special account, and the taxpayer could have used the money any way he wished, and thus the grant was includable in income and was not a contribution in capital. So the taxpayer did deposit the money in a special account, but the court said since no contract required it, no legal consequences follow, i.e. the dominion and control. So this is one of the cases you want to read closely if you're doing grants. And I can't pronounce that, Babo Kovari Cattle Company versus Commissioner. A rancher made improvements to his acreage and was awarded a sole contribution grants, which required compliance with governmental regulations. But the Ninth Circuit held that the rancher exercised dominion and control over the grant because no portion of it was required to be placed in a particular account or fund. The payments were not earmarked as to how could they be used. There was no restriction on the use of the funds. The court held the petitioner was free to use the money for any purpose it saw fit, for example, to defray operating costs or to pay dividends or to purchase an automobile. Therefore, the funds were includable in gross income. Again, that's a case you want to read very closely, because with a little bit of lawyering, you can meet the lack of dominion and control doctrine. By contrast, in Bailey and Commissioner was a case where the court held there was not, the taxpayer lacked dominion and control. So the taxpayer got a grant from Pittsburgh's Urban Redevelopment Authority, which was designed to provide facade rehabilitation for buildings in an historic district. And as a condition of the grant, the taxpayer covenanted it would make certain improvements and not to make other improvements without the consent of the Urban Redevelopment Authority. The court held the grants were not taxable because the taxpayer could not have the work done on the facade without consent, and all the rehabilitation payments were made to the contractor and none were made payable to the taxpayer. In addition, the Urban Redevelopment Authority selected the contractor, negotiated the terms of the contract, and paid for the work performed. So the court noted, unlike in prior case, the taxpayer did not have complete dominion and control over the project, and held that the taxpayer's unfettered use of the funds received was an important factor in determining whether they were includable income. And under the facts of that case, the taxpayer did not have unfettered use of the funds. Now, as you read that case, you'll see many grants could easily fit under that if the grant was lawyered up or structured in a way to follow that. And sometimes that's a practical matter you're doing anyway, but the grant should explicitly read, should follow the Bailey versus Commissioner, just to make sure the IRS can't come in and hold that they're taxable to either the corporation or the partnership. So Bailey versus Commissioner is another case to closely look at to make sure a grant that your client receives is not subject to taxation because the taxpayer doesn't have complete dominion and control over the project. So the lack of dominion control rears its head in a large way, particularly corporations that receive grants. A grant in South Carolina by our coordinating council is made to local governments, which in most cases is to the county. Many are earmarked purely for public infrastructure, such as road, water, and sewer. And the county generally arranged for those infrastructure improvements, and the taxpayer doesn't receive any funds. So following Bailey and Commissioner, a manufacturer, which is a beneficiary of it, the road, water, and sewer improvements are done for the manufacturer's benefit, but it typically is not going to have dominion control. The manufacturer rarely has control over the public infrastructure work, and the infrastructure payments are made to contractors, not to the manufacturer. In addition, the county typically is the party that selects the subcontractor, negotiates the contract, and pays for the work performed. So you just gotta make sure the grant includes all of that, which is a practical matter. It's how it works anyway. So you just want the grant to state all of that and not just go over what normally happens anyway. So it's likely parties will now pay a lot closer attention to the grant documents and will work to minimize the federal income tax consequences. And this is particularly so where a grant provides funding for both public infrastructure as well as free land or brick and mortar, i.e. private infrastructure to the taxpayer. So where the grant provides funding for two things, public infrastructure and private infrastructure, you need to make sure that the grant is worded appropriately so that public infrastructure dollars are not taxable to the corporation. Refundable credits have always been taxable. And a refundable credit is where you receive money in excess of the taxes that you pay. And a refundable credit is very much a term of art, and refundable credits have always been subject to taxation. In South Carolina, our taxations are almost always not refundable. They offset your income tax liability, or in some cases your sales tax liability, but they're not refundable. And so we do have a few refundable credits, but none of the traditional South Carolina economic development incentives, such as jobs tax credit, investment tax credit, abandoned building credits, are refundable. So the refundable credit taxation rarely, if ever, is going to rear its head in South Carolina. So the IRS has addressed refundable credits. So in Michigan, they were credits given. Some of them were not refundable, and some of them were refundable. And so the IRS held that the refundable credits were subject to taxation. And that was done before the passage of the act. So in Maines versus the Commissioner of Revenues, the state of New York gave taxpayers credits. They gave them immunized zone credits, wage credits, and QEZE credits. And so certain of those credits were limited to a refund of the actual taxes paid. Others were refundable, meaning that you could get cash over and above the amount you had paid in tax. So the IRS held that the enterprise zone tax credits that operate as refundable overpayments were subject to federal income taxes. Transferable credits is another example. South Carolina only has one unlimited transferable credit, the Conservation Act credit, where you can sell the credit. Several other tax credits in South Carolina can be transferred to the purchaser or the tenant of a project. Other states have a lot more transferable tax credits than South Carolina does. And so where the credits exceeds your basis, then they are subject to income tax. So where you can sell tax credits, it is subject to federal income taxes, and that's before and after the legislation. The IRS held in a lot of cases the argument whether they were subject to ordinary income or capital gain, and the court held that the tax credits were taxable, transferable tax credits were taxable, but they were capital gain rather than ordinary income. So we have South Carolina, like all the southeastern states, has SALT state tax incentives. And the IRS has been very pro-taxpayer in saying they are not a SALT tax credit exclusive of refundable or transferable credits is not income, it's not a contribution to capital, and it doesn't reduce a corporation's basis. But because of these tax incentives, whether in the form of an abatement, credit deduction, rate reduction, or exemption, simply lowers the tax imposed by local government, and they are not subject to federal income tax. So this applies under both the former and the current law. So South Carolina has a wonderful job development credit. It's one of the best credits we have because it's a withholdings tax credit. You know, so many manufacturers have no income tax liability because of huge deductions and huge credits, and therefore an income tax credit such as our jobs tax credit really doesn't do them a whole lot of good. By contrast, the job development credit is a withholdings tax credit, and even the Catholic Church has a withholdings tax liability. Every manufacturer, warehouse, or distribution has a withholdings tax liability. So it's a wonderful credit. It is not subject to taxation under the former or the current law, even though we style it as a quote refund, end quote. It's not refundable according to the IRS's definition because the credit is limited to the extent of tax owed. You can't get more of a refund than what you've paid into taxes. So it just lowers your withholdings tax liability, and it should not be subject to gross income. We have a bunch of, since our property taxes are so high in South Carolina, we have a bunch of incentives. The big one is fee and lieu, multi-county industrial park, special source revenue credit, and the manufacturer's abatement. So these incentives just simply lower the property taxes that would otherwise be paid and are not refundable. And so these are not considered taxable income to either corporations or LLC. And the conference committee report to the huge bill noted, by contrast, i.e. given land by a municipality, a municipal tax abatement for locating a business in a particular municipality is not considered a contribution to capital, and it's not subject to income taxes. South Carolina has a host of sales, like South Carolina, like all the southeastern states, has a host of sales tax exemptions, particularly for manufacturers. There are exemptions for machinery and equipment, R&D, electricity, pollution control, material handling equipment. Again, these exemptions are not refundable. They simply lower what you would otherwise have to pay in sales tax, and almost certainly are not considered taxable income. For income taxes, South Carolina, like most of the southeastern states, has a 100% sales factor, and manufacturers and some providers only pay state income taxes on income earned from sales to South Carolina customers. In addition, South Carolina has a host of income tax credits, including jobs tax credits, R&D, investment. None of these incentives are refundable, and for the reasons stated above, the incentives are almost certainly not considered taxable income to any form of business entity, be it LLC or a corporation. Grants, of course, is an entirely different subject. So South Carolina and a few companies have governmental grants programs. These include the set-aside funds, rural development funds, and closing funds. And typically the grant funds from the Department of Commerce are in the form of a check made payable to the county for public infrastructure improvements. And in that scenario, they would probably not likely be considered taxable income, even if a single private entity was the beneficiary of the grant. On some occasions, however, the grant program will benefit the private sector development prospect directly. For example, reimbursing the cost of site prep or actual bricks and mortar construction. And so this is a tougher case if the company has dominion and control over the funds. And you're going to be arguing with the IRS whether that is taxable. And as I've indicated previously, the IRS is already going to know how much money you've received, the corporation has received, because it's on the Department of Commerce or county's government website. TIF is another one, and I've quoted at length a law review article which says that TIF funds may be taxable to the private sector developer, and in some ways that income taxation is going to really hurt the TIF financing. So TIFs in South Carolina and probably most states come in two flavors. One, the city or county develops a TIF purely for its own purposes, and a real estate developer is not typically involved. So the TIF is done for purely public infrastructure, and there's typically not a real estate developer involved, although, you know, building a beautiful park may help the real estate developer who's building a hotel next door. In other cases, though, the TIF is done by a real estate developer. So the city or county has to pass the TIF plan, but the real estate developer hires and pays the contractors and is reimbursed from the TIF funds. So that's whether the developer receives grants funds from the city or county, it raises the specter. The IRS will view the grant as taxable. So you need to look at the cases I've mentioned before, the dominion and control exclusion from gross income, and draft the TIF development project in a way so that the developer, even though the developer benefits from the TIF funds, does not have dominion and control over the funds that are being paid. So as I mentioned, there is an exclusion. The Act contains an exclusion. The provision shall not apply to any contribution where the governmental unit established a master development plan prior to the effective date provisions of the Tax Cuts and Jobs Act. So that's a TIF plan that was established prior to December of 2017. And a TIF redevelopment plan is likely a master development plan. The IRS hasn't said that, but you certainly have a strong argument in that regard. And as I've indicated, the IRS has never defined what is a, quote, master development plan, and that definition is not found in any dictionary or Black's Law dictionary. So the issue with the TIFs is TIFs always last years and many last decades. So and the issue here would be a TIF that was enacted in 2012 is, you know, obviously it's probably subject to that grandfather clause. So the issue is, what if the redevelopment plan was enacted in 2012 and amended in 2018 or 2019? And that is very common in South Carolina, redevelopment plans being amended. Are you outside of the grandfather clause if you amend it after December 22nd, 2017? And in some cases, in order to get under that grandfather clause, you want to amend it to add non-contiguous parcels so that the real estate developer is not subject to income taxes on the TIF payments. So how do you reduce the tax consequences? There's not a whole lot of lawyering or structuring that a taxpayer can do to reduce the income tax consequences, but there's some. The classic example is a grant which provides both public and private infrastructure improvements. So in this case, two grants should be used, one purely for the public infrastructure purposes and the other for private infrastructure purposes. If you do one grant, you run the risk that the government is going to include the public infrastructure expense funding as taxable to the private corporation. And in many cases, the public infrastructure purposes are done purely to benefit one particularly private entity. They're done to benefit one manufacturer, which is going in there and using the public road, water, and sewer. So it's not a big stretch for the IRS to claim the public infrastructure and funds are taxable to the manufacturer. So the easiest way to try and minimize it, doesn't necessarily going to work, but you would want to do 2 grants so that the public infrastructure expenses wouldn't even mention the manufacturer. There'd be no mention of the manufacturer in there, and so you would have a shot at excluding those funds from federal taxation. You also need to closely examine the dominion and control exception and structure the transaction so that private taxpayer does not have dominion and control. And in many cases, that's done. That's a practical matter. That's what's done anyway. But it's got to be the grant's got to say that. The grant's got to be drafted in a way that says that the manufacturer does not have dominion and control over the funds. Merely the fact that as a practical matter, the taxpayer doesn't, that doesn't work. As you'll see in the case law, that doesn't work. The grant document has to say that. So the sunset of the Federal Tax Cuts and Jobs Act, as you know, it largely expires in 2025, and there's a huge amount of press regarding whether or not Congress is going to allow it to expire or not. And I'm not sure if this particular discussion we have discussed above expires if it's not reenacted by Congress. The bill is so large, I wasn't able to quickly discover whether or not it will expire in 2025. Congress is so dysfunctional, it almost seems to a certainty that some of the Job Tax Act is going to expire, but not all of it. So if that particular provision does expire, make sure all incentives flow to the corporations and not LLCs. So that's it. That's it for me. We've been over it at length. As I mentioned, I have 3 listservs. Just email me if you want to be on any of them. And I have a lengthy paper, 25 page paper that discusses in detail everything I've discussed above. And you probably want to look at it just to make sure you're fully aware of the dominion and control exception, because you want the grant to be drafted in a way that the private taxpayer not seen as having dominion and control. So my email address is Bernie, BURNIE.Maybank@arlaw.com. Just email me or give me a buzz and I'll send it to you. Thank you so much, and thank you SEDC for allowing me to come on and explain a very complicated topic.